You are listening to Climate Now. I'm Catherine Gorman.
And I'm James Lawler. And today we are going to talk about climate change risk to the housing market. How large are these risks? Where do they occur? And who is actually holding the risk?
And joining us to explore these questions is Amine Ouazad. He's a professor of economics at HEC in Montreal, where he has an endowed research professorship in urban and real estate economics. He is also a senior fellow in the 21st Century Initiative at Johns Hopkins University. Amine, thank you so much for taking the time to join us today.
Thank you very much for the invitation to speak. Really appreciate it.
So the first question that we ask all of our guests is always the same. How did you get where you are? Tell us about what your journey, your path has been.
Sure. I started working on housing and real estate after the great financial crisis. I sort of graduated in 2008, and everybody was talking about this massive fault line in the U.S. economy. That was mortgage credit. Movies were made about this and talking about the Big Short. And so sort of this topic, which was arcane and technical, suddenly came to the forefront, and everybody was talking about mortgage-backed securities and Fannie Mae and Freddie Mac, and you felt that by studying this topic in detail, you were contributing to helping the economy become more resilient, and you were helping homeowners sort of go through what was, historically one of the largest crises in the world and U.S. economy. And so I sort of, spent a good decade studying these issues, being a research fellow at the International Monetary Fund. And, a little bit like now, when there is a reckoning that climate is one of the most important issues, there was a reckoning back then that housing was suddenly something that people didn't know so much about. They thought that there were housing economists, and that was just a separate category. You were a housing economist. And now it's like everybody wants to be a housing economist. And I feel that this is also happening with climate change. Then I looked at the evidence, and I looked at the impact this could have on households' ability to retire, households' consumption, well-being, and then I realized that, climate risk could be a crisis that compounds a sort of a housing crisis, and that's when I sort of realized that this was not something that was a small problem.
Let's actually start there. Can you tell us the size of the mortgage market today? How much money has been lent to individuals to purchase their homes in the United States?
We're talking about $11 trillion of mortgage debt.
So that's a huge dollar amount. Can you put $11 trillion into context for us?
I can relate this to the total wealth, because I think that's sort of the way to represent this is there's about $100 trillion of wealth according to the Federal Reserve.
Okay.
So we're talking about, and the real estate wealth, that is, the equity, if we add up the equity to the debt, we end up to about $30 trillion of real estate wealth. So it's about a third of the total wealth of the US. But a third looks small, but for the median household,
it's not small.
Real estate wealth is 70% of their wealth.
Right. That's still a huge number then in terms of total outstanding loans that have been used for property acquisition. What percentage of that has been deployed in areas that are at risk of damage due to climate change?
I mean, that's a really important question, and let me sort of try to go through the way we can measure the exposure to risk. I started by looking at exposure to hurricane storm surges. So there are very good models for this, developed by NOAA. This is a model that's been used at least since the 1970s, benchmarked against actual hurricane storm surges. And the reports, there's a scientist called Jeleniansky who's contributed to this he suggests that they are correct within plus minus 20%. Hurricane storm surges can be dramatically damaging because, if you look at the simulations for a Category 5 hurricane in New Orleans, hurricane storm surges of 20 feet or more above ground level. That's very significant. So that's one type of risk. And so that's what I started with. Another type of risk is more slow moving, and it's sea level rise. And we have the precise granular maps also from NOAA of the impact of sea level rise on neighborhoods, neighborhood by neighborhood. So for hurricane storm surges, I find that the order of magnitude is about 10% of all mortgage originations in the US are in hurricane storm surge areas that is at least a foot of hurricane storm surge.
Let's talk about FEMA flood maps. Those are the maps that are used, I think, most commonly to decide who needs insurance, what kind of insurance they need, flood insurance, what sort of storm surges you might be experiencing.
Now, FEMA flood maps, and I think it's sort of a consensus now, are too thin, too small, and so just to give you an idea, there was a report of the city of Houston that suggested that more than 50% of the damages during Hurricane Harvey in 2017 was outside of what is called the 100-year floodplain. So,
which is the FEMA designation for their maps, right?
Which is the FEMA designation for their maps. So there's really been a move towards saying, we need independent measures of flood risk that is not solely dependent on FEMA flood maps. And and one of the things that I have to mention is that there's tremendously high quality human capital, extremely skilled and devoted federal employees who've developed fantastic modeling. And I think there needs to be a little more sort of interagency communication to sort of, pool together all the knowledge that we have. If I think about the U.S. Army Corps of Engineers, NOAA, USGS, FEMA, HUD, the thing is that I think a lot of us, and that includes me, we work in silos. And so we need to sort of come together to get a sense of, what's the best way to measure the exposure.
And in this particular, so just to recap, then you find that roughly 10% of the outstanding mortgages are, have been used to purchase properties in these NOAA storm surge areas. Is that right? So
that's right. So the numbers
have some hurricane risk, about $1 trillion, 1.1 trillion.
That's right. That's about $1 trillion a year. The number is actually slightly increasing over time. So if we look at the evolution of the share of mortgages in those areas between 2012 and 2018, it's increased between 9% to 12%.
And this is annual mortgage origination, which we see to have increased by about 3 percentage points over the last decade in coastal areas.
That's right, exactly. So that's over 6 years, 2012 to 2018.
I see.
And these are not proprietary or confidential data. These are sort of publicly available data that are reported through the Community Reinvestment Act. So it's been collected since 1975, and it's mandated for all lenders that have a minimum threshold of assets or a minimum number of originated mortgages. So it's a very comprehensive data set.
So my next question is, based on your research, if a property is in a coastal area that is susceptible to storm surges and sea level rise, how does that change the likely default rate for such properties? Is there an increase in default rates for those properties versus baseline?
So what I have to say is something dramatic has happened since Hurricane Katrina. So Hurricane Katrina was a tipping point in the sense that in 2005 and in the next year, the hurricane triggered flood insurance payments. And so what we see is that, in fact, the amount of household debt decreased after Hurricane Katrina, and there were more prepayments of mortgages. That seems to be sort of a mild impact, because that's not defaults, that's prepayments. And so there's an established literature discussing this. And so when I started working on this issue, that seemed to have been the consensus. But then we observed, and the industry observed as well, that there was a decline in the take-up of flood insurance policies that's been documented by Caroline Kowski, and a decline in take-up in the number of flood insurance policies and in the dollar amount that is covered by flood insurance. Since then, what we've seen is that after Hurricane Harvey, there was an increase in default rates. So we've moved from a world where people are insured and they get flood insurance payments and their debt decreases, to a world where there's increased default. In 2010, default rates increased by about 6 percentage points, from 6.5%, from 2 to 8.5%. When after a hurricane, and that answers your question, we see that there are increases in default rates of a couple of percentage points. And I think
in those areas,
in those
areas, right. Okay.
Oh, it's very important. What you're saying is super important. Is like in those areas affected by the hurricane relative to the default rate in other areas. So it's really teasing out what is due to the hurricane storm surge, to what is due to borrower creditworthiness, to what is due to, just take an example, is that after Hurricane Katrina was in 2005. So 2007 was the beginning of the crisis. So it's really important to look at the impact of a hurricane separately from the impact of the evolution of the market. Same thing, Sandy happened in 2012. The mortgage market at that time is in a different state. So we really need to make sure we're comparing comparables, and that's what we're doing really carefully by looking at millions of mortgages. We have about 70 to 75% of the mortgage market that we cover.
Why is that? Why are there fewer people signing up for flood insurance? Have flood insurance companies changed their coverage somehow?
There are a few things happening. One of them is that flood insurance has become unaffordable in some areas because the what we call the fair premium, which is the premium that balances the budget of the National Flood Insurance Program, that fair premium should be much higher. And so premia have increased since Hurricane Katrina because of reforms of the National Flood Insurance Program. And so in some areas, the flood insurance payment is the size of the mortgage payment. And so there is a question of, do I take a mortgage where flood insurance is required, and that's typically an agency mortgage, or do I take a mortgage where flood insurance is not required, and I'm going to sort of have a more affordable mortgage, but then I'm not going to be insured in case of a flood. The second aspect, and that's harder to document, but I've heard this from members of staffs at the U.S. Congress. Senators' staff told me that there's a little bit of a paradox, because they go to industry presentations that say servicers are in charge of monitoring that flood insurance is paid. And there's servicers are saying, flood insurance is paid. But when we look at the numbers in peer-reviewed work, we see that flood insurance take-up is declining. And so what could be happening, and that's a hypothesis, is that servicers are not checking along the entire life of the mortgage, that people keep paying for flood insurance. So we have at least two mechanisms. And then there's a third mechanism, which is that when premia are unaffordable, if I buy a home that is outside of the 100-year floodplain, flood insurance is not required. And if it's expensive, well, I may just try to sort of bank on the fact that a hurricane is not going to hit my home.
I mean, what role do Fannie Mae and Freddie Mac play in all of this?
So Fannie and Freddie were created to ensure a broad access to homeownership for Americans. And they are very large companies. We were talking about the fact that there's something like $1 trillion of originations a year. They guarantee about 65% of the market. So they are extremely large companies. And American access to mortgage credit would be dramatically different without Fannie and Freddie. They ensure that lenders are paid regardless of the default of households when households borrow to buy a home. So you can see here there's something interesting, because the insured lenders are paid. Well, does that benefit lenders or does that benefit borrowers, right? Well, it benefits borrowers indirectly because it makes it easier for a household to borrow to buy a home. It makes interest rates lower. It increases approval rates for mortgages. It increases pre-approval rates as well. So it's also a double-edged sword. We stabilize access to mortgage credit, but does that mean that we're going to give mortgage credit in risky areas? Now, that's the conundrum, is that should we make sure that we can get a mortgage in an area that can be flooded? That's the sort of the crux of the problem, and it's not an easy question.
So if I understand this correctly, you have banks and other lenders who are going out and providing these mortgages, originating these mortgages, but Fannie and Freddie don't actually provide the mortgages directly, right?
That's correct, yes.
So according to your research, what role do Fannie and Freddie play in terms of changing the behavior of lenders in areas affected by these big billion-dollar natural disasters? Can you help us understand that?
Right. So the mechanism is as follows. So a lender originates a mortgage and then sells that mortgage to Fannie Mae or Freddie Mac. And Fannie and Freddie transfer that mortgage into a mortgage-backed security. There are details here because there's two steps of securitization, but they package it into a mortgage-backed security. They give the lender back a share in the mortgage-backed security, and Fannie and Freddie guarantee the loan. So Fannie and Freddie get the payments from the borrower, but the lender gets the payment from Fannie and Freddie and the servicers. So the lender is insured, because for the lender, it's as if the borrower was never defaulting on the loan. Mm-hmm. Whereas for Fannie and Freddie, they need to make sure that when the payment doesn't come, they're sort of plugging that gap and making the payment instead of the borrower. So what we find, and that's where the crux of the issue is that lenders see this ability to sell to Fannie and Freddie as a sort of a safe option for them, right? And so in the aftermath of natural disasters, when lenders suddenly learn that there are defaults due to hurricane storm surges in some areas, then they start selling those loans to Fannie and Freddie instead of keeping those loans on their books. And
so you found, just to emphasize that, you found a statistically significant change in behavior of lenders in, post-disaster scenarios. And you and your colleague described a disaster, these quote unquote billion-dollar events. So natural disasters that cause $1 billion or more of damage. And you found a statistically significant change in behavior of major lenders. So we're talking about big banks selling more, getting more of these off their books and onto the books of Fannie and Freddie, which is effectively, as we know, backstopped by the U.S. taxpayer, right?
Yes.
So the risk is there's a transfer of risk happening between lenders, right, who should be properly pricing this risk in the first place, but you're implying that they are not, right?
Yes.
And transferring that risk onto all of the rest of us.
Yes.
Am I capturing that? Okay.
That's correct. Since 2008 Housing Economic Recovery Act, Fannie and Freddie are under conservatorship because they failed, and the U.S. government took over the companies, and now the U.S. Treasury has technically what is called a funding commitment. So far, that funding commitment has not required the Treasury to pay Fannie and Freddie. Quite the opposite. In fact, Fannie and Freddie have given money back to the U.S. government, and that's something that people tell me about. But that's interesting because that was, Fannie and Freddie were profitable companies just before experiencing a large decline in their earnings. So the fact that today they are actually giving money back to the U.S. government is not a sign that they're necessarily not facing a crisis in the future. So so we do find a statistically significant impact of natural disasters on the propensity of lenders to originate and distribute loans to the agencies, instead of originating and holding these loans. And billion-dollar disasters, as you rightly pointed out, they include Hurricane Katrina, which was the event with the largest amount of damages, and they also include Hurricane Sandy. So it's maybe interesting for the audience to know that an analysis, I think, was published in Nature, did a costing of the damages from events for a century, and the top 15 events are all hurricanes. So the reason why we focus on hurricanes is because they're sort of the first order problem here.
And when we're talking about these billion-dollar events, how are Fannie and Freddie now taking into account climate-related risks in their operation? I mean, as they come out of conservatorship, do we expect there to be further changes, evolution? So
there's a short answer and a long answer. The short answer is the tool that was used so far was flood insurance. When you sort of see at the hearings, the typical answer is that flood insurance is required for mortgages that are guaranteed by the agencies. But there's a range of other tools that they also use. One of them is mortgage insurance. So that's separate from flood insurance. Mortgage insurance is supplied by insurance companies that make sure that those mortgages are paid on time. Now, there's some technicalities here that make it slightly problematic. Mortgage insurance can be dropped by a homeowner when its equity reaches 20%. So that's something I'm sort of working on, is understanding how that affects the agencies, Fannie and Freddie. The other problem is that the private mortgage insurers did fairly poorly during the great financial crisis. So part of the reason is that mortgage insurance is not structured in a way that protects the agencies against reimbursement risk. So, and there's a lot of dollars that need to be paid by the insurance companies. Do they have these dollars on their balance sheet? That's not obvious.
Okay, can you also explain to us this product Fannie and Freddie now use called credit risk transfers?
CRTs, credit risk transfers, what are they? They are a product that Fannie and Freddie started in 2013 to insure themselves against the risk, and by sort of doing something better than mortgage insurance. And the program was successful until 2019. There was a large increase in credit risk transfers, so that's transferring the risk back to hedge funds, investment banks, people who sort of want to take the risk. They want this sort of high yield investment. And so we transfer them instead of having that on the books of Fannie and Freddie and thus the US taxpayer. We make sure that it's insured by hedge funds and investment banks and all that. Now, this was going well until 2019, but there are two issues. One is we discovered in our work, it's in the latest version of our work, that Fannie and Freddie selectively transfer risk, and they transfer less of the climate risk. That's what we call positive selection. Positive selection is actually not very positive. It's that actually Fannie and Freddie are keeping climate risk on their books. This may be an unintended effect of the transparency of credit risk transfer. So the investors can see which mortgages are in these risky areas. So they're probably, they could be consistent with a mechanism in which transparency, in fact, hurts the market. So I know there's a lot of conversation about transparency and climate risk on balance sheets. There's the Michael Bloomberg chairing the TCFD and accounting rules and climate risk. But I think we should be mindful that in some cases, transparency is bad. And then CRT issuance, that was a big surprise, collapsed in 2020. And we sort of think that it's due to new capital rules that disincentivize the issuance of CRTs. And so basically in the second quarter of 2020, there was Fannie Mae issued zero credit risk transfers. And we think that it's unfortunate because that's precisely the moment when Fannie and Freddie should be transferring risk back to the private sector.
So your research shows that Fannie and Freddie are carrying risk that they haven't properly priced. Could we be looking at another financial crisis similar to what we experienced in 2008 as a result of that?
Yeah, so the big debate is another big debate, and I think now it's sort of overlapping the climate debate is the capitalization of the agencies. And so there's a question as to what is the appropriate level of capitalization, because by private sector standards, they're highly leveraged. And so even a suggestion of 5% of capital is seen as a larger number than they've been used to. And so that means that the buffers are a little slim. I don't know of work that looks at the impact of climate risk on the capitalization debate. But that certainly you've anticipated what is one of the trends, I think, in this debate.
So zooming back out in an attempt to tease out what the main problems are that you and your colleague have discovered, it sounds like we have a problem on the flood maps where we have an out-of-date and grossly underestimating definition of where the risk physically lies. So that's one point. And then we have this other issue involving transfer of risk, which is being done sort of selectively to shield these large, mortgage originators from the risk. And those transactions are being conducted at prices that don't match the risk that those instruments actually carry. So on that second piece, how frequently is this happening? Who are the largest offenders in terms of the banks and other originators that are doing this?
Yeah, so I'll bring a little bit of nuance. I think, first of all, we need to say both bank and non-bank lenders. So, for instance, Quicken Loans is a company that doesn't take deposits, but greatly benefits from Fannie Mae and Freddie Mac's guarantees. And in particular, because they don't have deposits. So, in fact, they're originating practically no jumbo loan because they need to sell their mortgages quickly to Fannie and Freddie. The conundrum is actually a little more complex than it looks like, because here is something that will surprise you, but it looks surprising, but it's not that much. It is not clear that we want to price flood risk in mortgage guarantees. Why is that? Now, if you go to U.S. Congress and you say, I've had this great podcast with Amine, and I think we should price flood risk, the answer they're going to give you is that people who live in areas affected by hurricane storm surges have lower income, are more likely to be minorities, are less likely to have health insurance, and they are, in fact, underprivileged households. So should we reduce access to mortgage credit for these households? Staffers have told me this. They've told me, look, this could be redlining. So So there's a trade-off, and this is a complex trade-off. The trade-off is that if we price flood risk in mortgage guarantees, we're gonna reduce access to mortgage credit for these families. Now, is it good for their welfare? Because they could be more exposed to future floods.
Well, we know they're more exposed to future floods, right? We know that statistically, these are households that are just more vulnerable, right?
Yes. So but you see that is there's sort of something that we need to solve here. That we need to sort of help households transition to safer areas, and so and I think about a couple of policy avenues that are beyond the paper that we just authored, but FHA gives 0% down payment loans for households affected by natural disasters. That is,
and what is FHA? That's
Federal Housing Administration. They provide loans for lower income households, typically, I hope 3% down payment. And in case of families affected by natural disasters, it's brought down to zero. And one thing we could do is ensure that households take these FHA loans in areas that are on safer ground, that are on higher ground, that are less affected by hurricane storm surges. This is one policy idea. There are many others, but I think we need to think about transitioning households to make sure that it's very hard to leave a neighborhood. There's the church, there's the friends, there's the family, there's a lot of social ties. So it's not like it's not like a person is a singleton and can just decide to go wherever. I think we need to help communities transition to places that are safer, more protected. Here is an interesting fact that I think is really, really important, is that only 3% of land in the U.S. is urban. So the U.S. is, on first order, is an empty country, and most of the population is stacked on the coasts. And so these are where the jobs are. This is where the amenities are. And the question is, lenders are giving these loans in part because people want to live there. They get access to jobs and a number of amenities. So I think the big question is how do we sort of manage the retreat away from risky areas? And you see some private companies doing that already. So Goldman Sachs, for instance, moved its back office operations away from downtown Manhattan and to New Jersey on safer ground. And so they have understood that, yeah, it's okay, we're going to keep meeting our clients with fancy suits in downtown Manhattan, but all the critical confidential information that for our operations is going to be on safer ground. If Goldman Sachs can do it, I think, we want to think about helping those who can't adapt like Goldman Sachs. I don't have an answer to you as to how we're going to address this conundrum of pricing risk without hurting lower income families, but that's definitely, I think, the most important question.
Thank you so much for your time. Obviously, so much more to unpack and explore here. Such a pressing topic. As you say, the social justice implications alone are so critical. Thank you so much for your time today. We really, really appreciate it.
Thank you for the invitation. Thank you.
Yes, thanks, Amine.
For more on this topic, you can check out the links in our show notes to Amine's research and other related papers. You can also head to our website, climatenow.com, to check out our other interviews, watch our videos, sign up for our newsletter. And if you want to get in touch with us, email us at contact@climatenow.com or tweet at us at @WeAreClimateNow. And we hope you'll join us for our next conversation.